Every year, Hawaii property owners pay over $100 million to capital gains taxes. And the craziest part is most don't even realize that it's happening. Hi, I'm Randy Ihara.
And I'm Dan Ihara.
And welcome to the Advisor Podcast. We are real estate wealth advisors here in Hawaii. Today's episode will answer the questions that you really want to know. So what is capital gains tax? How will capital gains tax affect you? And how do you avoid capital gains taxes legally, right? That's the question we all want to know. Since this is our first episode, we wanted to just give a brief introduction to who we are and our team. So Dan here started the Ihara team over 2 decades ago, a real estate team that has helped more than 1,500 families buy and sell real estate, totaling over $1 billion in sales. Through his experiences, he's learned what truly matters to most clients: how to defer and eliminate capital gains taxes, how to find safer living environments for seniors, and how to prevent family disputes before they even happen. Dan is also a national coach and trainer, teaching hundreds of real estate agents across the nation on how to elevate themselves from a traditional real estate agent to a real estate wealth advisor. His mission has always been to become the best realtor he could ever be, which meant learning the things that deeply impact his clients, even when the real estate industry says not to talk about it. Because if it matters to our clients, it's our responsibility to help them and navigate them through that. So, going on to our first question for you, Dan, what is capital gains taxes and why does it take so much of our clients' money?
Yeah. The government has this capital gain tax that they collect from people that have gain, right? So they don't take money from people that don't gain. It's all about the gain. So what is the gain? It's from what you bought it at minus what you sell it at. There's a gain there, right? And so you have capital gains taxes on kind of all your assets that you have a gain, but except for real estate. So real estate, they have a couple rules to that gain that allow you to defer it, or you actually eliminate that capital gain tax.
Oh, wow. Okay. So if I'm hearing you correctly, capital gains tax is only when you sell the property?
Yes. It's
Okay.
only when you sell a property. You don't have a capital gain tax incident while you own it. The incident happens upon sale.
Got it. And how much is capital gains taxes?
Well, it depends on each state, right? So long-term capital gains taxes at the federal level, it's up to 20%. If your adjusted gross income is greater than $400,000, you add another 3.8 on top of that. And then if you're in the state of Hawaii, you add another 7.25%. In the state of California, you add another 14.4%. I think there's like 8 or 9 states that have zero long-term capital gains tax on the state level, but the federal level still exists.
Got it. And keep in mind also to everyone listening that your capital gains tax, the gain that you have from your property will be included in your adjusted gross income, right? So just a quick story. We had a client that, they had an investment property that they wanted to sell. There was going to be a huge capital gains tax liability that they had, right? And so we created a strategy, a 1031 exchange to defer the capital gains taxes. We walked them through that whole process. And the property was in California, so we didn't personally want to sell that. And so we haven't heard from him in a couple months. We followed up with him to see what happened. And he said, oh, no, we just sold it. We didn't do a 1031 exchange. And I asked him, what about your capital gains tax liability? And he's like, oh, no, I'm retired. I don't have any income. I'm not going to have any capital gains tax.
Yeah.
Well, he's going to have to pay, unfortunately, $100,000 in capital gains taxes. And that's just a lesson that we want all of our listeners to know about as
I
well.
wonder how he felt after that one.
I know, right? It's a lot of money.
Yeah.
So tell me, what's the difference between short-term and long-term capital gains taxes?
Yeah, it's time, right? So 12 months in a day is long term. So if you sell something and you own it and then you sell it within 12 months, that's short-term capital gains tax. Long-term capital gains tax, it takes place after 12 months in a day that you've owned it.
Okay. And what is the difference in how they calculate the actual tax burden on that?
That's a good question. It depends on that individual, right? On their tax situation. Typically, short-term capital gains taxes are significant. It could be 30, 35% at the get-go, depending on your tax bracket.
Gotcha. Yeah, so Short-term capital gains tax will be a tax at the ordinary income level.
Yes.
And then, like Dan mentioned earlier, the long-term capital gains taxes could be that 15 or 20% for federal capital gains tax on top of the state capital gains tax, as well as potentially the net investment income tax as well.
You know, one of the things I think we want everyone to know, though, is that we're not tax consultants.
Yes,
We're not
yes.
CPAs. We're not, we understand the rules of the game, but we don't actually do that work. So anytime you're concerned about taxes, we can help you get a napkin test on that, meaning get a general idea and a guesstimate on it. But the person you really want to speak to is your tax consultant, the person that your CPA or your somebody who's doing your taxes, and ask them those questions. And that's one of our first pieces of homework for our clients.
Yeah.
Is here's what we think it is, but you go tell us what your tax consultant says.
Yeah.
Right?
Yeah.
Yeah. It's really important.
Okay.
I'm not that smart anyways.
So why do so many homeowners not know about capital gains tax?
Yeah, it's a good question. You know, we buy properties, we keep them for a long time, they appreciate, and, we really, the world doesn't really talk about it as much as we probably should. And that's one of the reasons why we have this national mission, right? To train real estate agents, because I truly believe that the reason why consumers don't know it is because realtors don't talk about it. Right? Yep. And I travel the country all the time, right, Randy? And I ask realtors, do you ask one simple question? Do you understand when you speak to your seller, do you understand your capital gains tax liability in the event you sell your real estate? And guess what? 0 people ask that question. It's crazy, right? Well, we always ask it because we want our client to be aware of their consequences in selling. But I think the real reason is, I think there's 2 reasons for that, Randy. Number one is the industry, there's a void and gap in training and knowledge. And that's what we're on this national mission to change because of our training nationwide. But the other is, it doesn't really impact the agent's money, does it? Right? Nope. And it impacts the client's money. Yeah. And the industry, the real estate industry that I love so dearly, does not encourage or support the agent from learning this to ask the question, to bring knowledge to their consumer, to actually care about the client's money. Yep. We're really good at making us money. Right? All the training that I've seen is all about the agent making their money. Yep. And so that's the difference that this movement that we have, real estate planner movement, is really designed to educate real estate agents so we can educate the population about this key point that is going to impact generational wealth.
Yep. Yeah, capital gains tax, the largest enemy of building generational wealth.
Yeah.
And yet most real estate agents will never talk to the clients about it. Yeah. Okay. So I'm sure a lot of our listeners are wondering, will capital gains tax affect me? And how would you explain that? How would they know if that's going to affect them?
Well, it's going to affect them if they sell real estate. Okay. Well, it could. I'm not saying it will. It could. How do I know? Is I look at their cost basis, what they bought it for, the value that it was transferred to them at, and then I figure out what we think we could sell it for, less the cost of selling. There's a gain there. And I take a look at that gain, and then we put a percentage on. In the state of Hawaii, the rough, comfortable, simple number is 30%. Yeah. And so you take 30% of that gain, you're going to be giving that to the state and federal government.
Wow.
I love my country. I love my government. Yeah, I kind of like my family a little more than the government.
Okay. So that's kind of the high level. Maybe could you dive maybe a little bit deeper on the actual calculation and how you calculate that?
Yeah. Real in the simplest form, let's say I bought a property for $500,000 and I sold a property for $1 million. I have $500,000 of gain. Well, I think one of the things we may want to step back at just a moment on in capital gains taxes is there's 2 types of properties that you will own, right? Many people have their primary residence, and then those who have more than one property, they have an investment property. Well, the primary residence, which most people have, right? If you sell a primary residence, there's the IRS code, Internal Revenue Code 121, basically says that the government's going to give you a capital gains tax exemption. It's not a deduction, it's a full exemption of $250,000 per person. Okay. married couple living in the property, $500,000. And right now, there's really no other asset that we own that you could sell with $500,000 a gain and not pay any tax on it.
Yep.
Your home is it. And I train real estate agents and also financial planners and trust companies, and they understand that. They understand that if you sell their home, you won't have to sell other assets that could have a tax consequence in.
Yeah.
So on their home, and everything in excess of that $500,000 of gain on their primary residence, yes, will be subject to capital gains tax. And at a future time, we'll talk about how to avoid that as well. But for the simple conversation regarding your investment property, something you did not live in 2 out of the last 5 years, it's the same formula, right? What's your cost basis? What's your property you're going to sell it for? Less the cost of selling, there's a gain. And you're going to be subject to about 30% in the state of Hawaii. Each state is different.
Got it. So the investment properties, those don't have any exemptions on there?
No. No. Well, you got to do a 1031 exchange to avoid the capital gains tax.
Okay. Yeah, let's maybe talk a little bit about that. How do people avoid capital gains taxes?
There's kind of 3 ways to do it.
Okay.
Number 1, don't pay it.
Okay.
But I tell people, you're probably not going to look good in that orange suit and the food's not that good. So I wouldn't recommend that. Federal prison's pretty bad. That's what I hear. So I would definitely not choose option 1. Option 2 is you do a 1031 exchange and you defer your capital gains taxes. That's what most people do. And when we meet with people, that's what they all do, 1031 exchanges. And then the third way is something that I know you're going to do is you're going to leave this planet one day, not in an airplane. I mean, you're going to die one day. That's one of those guarantees in life, right? At some point in our life, we are all going to expire, right? And that's how you get a step up in cost basis. Gotcha. Therefore, your heirs have no capital gains tax if they sell it within a reasonable time period.
Oh, so talk to us a little bit about the step up in cost basis and how does that
So the step up in cost basis is where upon death, if I hold this asset until I die, then the value gets determined at the date of death. So we do a date of death appraisal, or if you sell the property within 6 months of passing, typically what accountants and tax consultants have told me is that the IRS typically recognizes the step up in cost basis to be the value at the date of death, which is the sale price, if you sell it within 6 months. But again, please seek your tax consultant for that. So that's one way to avoid your capital gains taxes. You die, right?
Okay.
The most common area that we see is 1031 exchanges, where you sell an investment property, you use a tax code called 1031, you buy another property of equal or greater value, and you defer that capital gains tax.
Gotcha. Can you talk to us a little bit about the 1031 exchange and how that works?
Yeah. So there's 2 basic rules to this game of 1031 exchange. Number 1 is a designation rule. Right? The designation rule says upon the date of the sale of the property I'm selling, we call that the relinquished property. From the date of the relinquished property closing, you have only 45 days to assign a replacement property. Right? It's putting an address or a tax record on a piece of paper you have available for the IRS. And that's where people get stuck because it's a small window. It's a month and a half, right? Of like, holy smokes, I don't know if I can find a replacement property. And that's why people kind of opt out. Randy, we've done almost 400 of these things and we've never failed one. And there's a reason for that because we have a process to it. And at some point we'll talk deeper about that process. But that's rule number 1 is a designation rule.
Okay.
The designation rule actually has a subpart to that. And that says that you can designate as many properties as you want, up to 200% of the value of the relinquished property. So if I sell a property for $1 million, I can designate as many replacements I want, up to $2 million. That really hasn't played a part in our business as much. When would it? I think if you sold a property somewhere in the coast of our country or high valued and you go to the inner part of our country, in Ohio where you're or Tennessee, or I'm buying, or Georgia, I'm buying a $100,000 property, I'm selling a $4 million property. Yeah, you're going to need to have more than 3 of these, right?
Yeah.
And so that's why the 200% rule is there. So that's one rule, the designation rule. The second rule is the closing rule, which means upon the closing of the relinquished property, you have only 180 days to close on the replacement property. Roughly 6 months, but we say 180 days because there's no grace on these time periods, right? The government, the federal government, they don't care if it's your birthday or if it's Jesus's birthday. They don't care why you can't close, right? You're gonna be subject to capital gains taxes. So there's no grace in the time period. So when doing a 1031 exchange, you absolutely must know your dates. And the date of closing, typically in almost every state that I know of, they don't close on Saturday and Sunday. So if you're planning on 45 days and that 45 days is on a Saturday and Sunday, and you're planning on that, so be it. You're gonna fail your 1031 exchange. Yeah, it's a big deal. We've never failed one. We've had 100% success, and it's mainly because we take this seriously and we know our numbers, we know our dates.
Yeah. And what happens if you fail a 1031?
There's a tax consequence to that, right? And in the state of Hawaii, roughly speaking, about a third of your gain is going to be paid to state and federal governments.
Wow.
Yeah,
Wow.
they're happy with that.
Okay. Tell us about a story when, a client maybe did or didn't want to do a 1031 exchange.
Wow, so many of them. How much time we got? We actually had a situation where a family inherited a property.
Okay.
And so my first question to them, Randy, was, did you inherit it upon death or before death? And they go, oh no, Mom put all of our names on the title before she died. And I go, ooh, that's a problem. And they go, well, why is that a problem? We're the owner. Yeah, that's the problem. See, remember we talked about a step up in cost basis? Yep. There's also a thing called a carryover in cost basis. And most people aren't aware of the 2 types of cost basis. And realtors don't even know. That's kind of crazy, right? Well, the consumers are kind of blown away by this. So this family, 3 children, the children were in their 60s.
Okay.
So mom and dad passed away in their 90s, and they had this property they wanted to sell, and they just thought, hey, let's just go sell it and spend the money, right? So we get there, and I ask them that simple question, did you inherit the property upon death or before death? And they said, oh, no, Mom gave it to me while she was alive. I said, ooh. They go, why? What's wrong with that? I said, well, that's called a carryover in cost basis. So let me ask you, what did Mom buy it for? She said, well, I bought it for about $45,000. I said, okay, well, if we sell it at 1.5,
Yep.
there's going to be a significant gain there, right? And so almost all of that's going to be gain. And a third of that, $500,000, is going to vanish into the government. Right?
Yep.
And so they said, well, what do I do about that? And I said, well, how do you feel about that? Because I'm not going to be the judge of people paying the government, right? I'm not going to tell them they can't do that. If they want to, have it. But most people don't. Right?
Yeah.
So when I ask the question, how you feel about that? They go, ooh, I don't want to do it. I said, well, if you would like to do a 1031 exchange, we can help you. I said, what's that? I said, when you sell this, you buy something else of equal or greater value. You defer the capital gains taxes until you die. Then your kids get a step up in cost basis. They go, oh, that sounds like a plan. That's what we're going to do. So imagine, Randy, there's 3 siblings, a son and 2 daughters. Well, a guy and two ladies. And remember, they're in their 60s. I think one could have been just north of 70. And they all said, let's do it, except for one of them. See, the 2 in Hawaii, they said, yeah, that makes a lot of sense. I'm going to do that. And I said, so all of our clients, I'm saying, before you do this, I want you to talk to your accountant because I'm not filing your taxes. And I'm not going to represent you against the IRS. So please talk to your CPA and make sure they're going to support you on this decision. Right? So they do that. The 2 here said, yeah, absolutely. That sounds like the best thing for me. I want to keep all my money. Well, interestingly enough, though, the daughter that lived on the mainland, in California particularly, she said, I'm not going to do that. I go, okay, so you're okay giving this money away? I said, well, no, I don't want to, but And then she pauses, and I go, "So what's the but? I mean, what's between you and saving your family this money?" She said, "Well, my accountant said I can't do it." I said,
Oh,
"What caused that?"
yeah.
She said, "Well, because they're illegal." I go, "Okay, well, would you like a second opinion?" So I introduced her to another CPA, and he tried to convince her. And bottom line is, this client was, I think she was in like 68 years old, 70 years old, and she goes to her CPA. Well, her CPA has been their tax consultant since she was 24 years old. It was her friend. And her friend's saying, "Don't do this because it's illegal." And I was like, wow. I said, "Well, you're going to make decisions based on what you want."
Yeah.
And so unfortunately, yeah, 2 of them did it, were successful. 1 didn't pay the tax.
Oh, wow.
Over $130,000.
Wow.
Yeah.
$130,000.
Yeah. That was their call.
Wow.
I can't be the judge of people spending money.
Okay.
Not my opinion.
Yeah. What's one takeaway that you've learned throughout your career and your experience that you wish you knew earlier?
I think what the world needs to know is that, and understand, is that there's 2 types of pieces of real estate, right? The one you live in and one you don't.
Mm-hmm.
And the biggest challenge I see is somebody buys a house, right? And then they upsize, so they keep that house and rent it. Or maybe that was mom's old house or a relative's house, but it's a family home. They keep it. Why? Because the world tells us don't ever sell real estate. Right? Well, unfortunately, though, they go and buy another property. Now they have an investment property. The biggest gap I see is that people don't see that as an asset, a real estate asset. They see it as a house with doors, windows, and a roof, right? It's going to house somebody, And when I ask people, how's it working for you, and they all say, "Oh, I love my tenant. Little Johnny, he's a great guy. Yeah. Little Johnny's been there for 25 years." Yeah, it tells me that they're underperforming. And so people, they don't actually see the real estate that they don't live in as an asset.
Oh, okay.
They hold it because they're told never to sell it. They hold it because of future appreciation, but they don't ever measure it well, right?
Okay.
And how do I know that? I ask people. I say, ask if you have an investment property, what's your cap rate?
Okay.
And nobody knows what a cap rate is. No, it's not the hat. It's not an extra large. What I mean? Yeah. It's not a small. It's a capitalization rate. It's a way to determine the economic viability of an asset, a real estate asset. And we measure those things, right? We measure them, and we try to find out, how is the rate of return on this asset? Because if you don't live in it, why do you keep it?
Yeah.
And what's causing you to keep it? And you say, "Well, it makes me money." Well, if you could make more money, would you? And they go, "Yeah." So what's the cap rate? And they go, "Well, I don't know." Well, here's what's really funny, and it's kind of sad in some cases, is that they get either from 0 to 2%.
Wow.
Rate of return. Yeah. It's unfortunate. But when we show that to them, most people make the wise decision, right? What does that look like? Well, we just measure it. We're saying there's no judgment on these numbers. The lady we spoke to today, she had a house vacant for 7 years.
Yep.
Think of all of that. So if you have a home that's vacant, what does that do for you, right? To us, we call it a negative asset.
Yeah.
It's an asset you own that you keep owing things to it, and it never gives you any money back. Yeah. That's probably not a good investment, right? Ask any financial wizard or financial planner. They're going to tell you that's not a good investment. Well, most people, they don't connect the dots on that because they see it as a house that's going to appreciate.
Yeah.
What we do is we know there's 5 pillars in building wealth. Appreciation is one of them, but cash on cash is another. How do you measure that? You take your income minus your expenses, gives you a net operating income, and that's a monthly basis typically. Then you multiply that by 12 because you have to annualize that number. Then you make it relative to the value of the asset, divided by the value of it today. So what I'm finding is that I ask myself, like, why do people not know this?
Yeah.
Right? How come it's such an interesting conversation when I ask them, "Do you know what your cap rate is?" And almost everybody says no. because we don't measure it. We don't measure the rate of return because little Johnny, he's a nice guy. He pays on time. If he pays on time, I don't want to kick him out. I don't want to have a vacant home.
Yeah.
Right? And so what most people look at is the easy route. Right? They want easy, they want simple. They don't want complicated or challenging. They don't want contentious. They don't want any of that. So they leave it there.
Yeah.
Right. And yes, it'll appreciate. But when I ask them the question, if you could make more money, would you? Funny thing, everyone gives me the same answer.
Yeah.
It's yes.
I would make more money if I could.
Right? And so I ask the question, well, and if they say yes, well, let's take a look and see if that's even possible. I can't guarantee anything. Well, I can pretty much almost guarantee in the state of Hawaii that you're not going to get 5% here. Right? There's other assets you can generate and sell and buy another asset, which means if you sell the investment property, buy another investment property via a 1031 exchange, you remove the burden of owning it. You don't have it anymore. You remove capital gains taxes. And that's why most people don't sell. It's because of the capital gains tax.
Yep.
Well, we became the national expert in that. And so we help them sell a property, buy another property, eliminate capital gains taxes. But most importantly is to find out, how's that working? Is that going to generate you more money? And so we have to find an asset that can generate more money than the one that they are selling. When we do, they end up wanting to do it. Right.
Yeah.
And it may be in Hawaii. So in the state of Hawaii, we're looking at average of maybe 2 to 4% on the high side of cap rates. We're seeing short-term rentals, maybe 5, closer to 6. In Hawaii, that's it. But, you can buy in other places, right? And this 1031 exchange is available for any state in America. So we could sell in Hawaii and buy in Georgia.
Yeah.
Right? Where it's cheaper, where you've got 14% cap rates.
Wow.
So you could do things like that. We are investors, so we scour the country, and we've got a number of properties in that area. We've got one in Mississippi and 2 in Georgia that are anywhere from 12 to 15% cap rates.
Wow.
Yeah. Now, keep in mind, those are not going to have the appreciation ride that we'll have in Hawaii, but I tell you, it's going to make a lot more money.
Yeah.
Right. And so you're going to have a balance of that. And then you've got areas in the country where you get a little bit of both, a little bit more of both. Right. But when I ask older adults, would you like to be an active investor or a passive investor? You know what they tell me?
Passive.
Yeah. Nobody wants to be an active investor. And, when they were younger in their 20s and 30s and maybe 40s, they invested in the property and they fixed it up, they cleaned it, they rented it themselves, they fixed the refrigerator, and they did all those things. That's an active investor because they were building well, right? But when you get to 60s, 70s, 80s, and 90s, they don't want to do that anymore, right? It's kind of boho, you don't want to do that kind of stuff. Yeah. It's kind of humbug. So when I ask them, would you like to be an active or passive investor? They say passive. Now, how do you get the passive, right? Well, if I sell an investment property and buy another one, that doesn't change the game for me. I'm still responsible. I'm worried about the tenant paying on time. I'm worrying about property taxes rising. And heck, right now, where our biggest concern is insurance rates rising, or even being able to get insurance. That could be problematic, right? And so how do you get the passive? Well, we found a tool a number of years ago, probably about a decade ago, that you can actually sell an investment property, buy another investment property, but it doesn't look like what you're normally used to. It's a professionally managed asset, right? It's kind of similar to a REIT, a real estate investment trust. Large organization buys an asset, they rent it, they give you money. Well, the REIT's not acknowledged from the IRS's perspective as a suitable replacement property for a 1031 exchange. It's just not. So about in 2004, a group of teachers came together to start something that was groundbreaking in 2004. And that was this tool called a Delaware Statutory Trust, a DST. This asset was professionally managed, right? Yeah. Professionally managed so that you didn't have to worry about it. And it generates today, we're getting about 5% rate of return.
Okay, so a lot better than Hawaii.
Yes, yeah, and when I ask them if you'd like to make more money, um, would you like to be a passive investor? That's kind of the best route for them.
Ah, okay.
Yeah, and do you know why most people don't know about it?
Tell me. Tell me.
Yeah, it's because it's only for accredited investors. So the Securities and Exchange Commission, as well as the IRS, says you can't promote this to the world
Yeah.
because the world can't buy it.
Mm,
Only accredited investors buy it. You know what accredited investor is?
no.
Accredited investor is a person that has a net worth of $1 million in excess of their home. So outside of your home, if you've got $1 million of net worth, you're an accredited investor. Now, these companies that design these
Yep.
DSTs, and by the way, a DST can be, for example, the ESPN News Center is a DST, and the Amazon warehouse in North Carolina is a DST. You've got strip malls and hospitals as DSTs. We're an investor in one ourselves where it's, I think, 3 apartment buildings in 3 different states, right? But it's professionally managed.
Mm.
So since I've owned ours, no one's ever asked me to fix the washer and dryer. Nobody asked me for my money because the maintenance fee went up.
Yep.
It's a passive investment. I get in my asset, because I bought it a while ago through a different company, it's only 4.5%. Today they're getting 5, and this is conservative.
Mm.
There are DSTs that can get up to 8%, 9%. But no, with higher rewards, there's higher risk, right?
Yep.
And most of our clients are in the position of asset preservation,
Yeah.
right?
Yeah.
They don't want to lose the money because they're not going to be around to make it up, right? So the DSTs became our go-to solution.
Okay.
The other reasons why you don't know about it, or most people don't know about it, is because they can't. The sponsor company and the broker dealers, they can't advertise because it's only for accredited investors.
Ah.
Yeah. Number 2 reason is realtors don't get paid on it.
Mm.
So what a typical realtor wants to do is they want to sell a property and buy a property and get paid in commission on both.
Yep.
Well, they're going to get a commission on the sale, but they won't get a commission on the Delaware Statutory Trust or an UPREIT
Mm.
because they're not typically licensed to get that money. You need a Series 7, I believe, to get that commission. So that's why realtors don't bring it up, because they're not going to be benefiting from it.
Oh, okay.
Yeah.
Okay.
We do, only because I've been a believer in it for a decade and I own one and I get the benefit of it. The other is in Hawaii, I can't make our client 5%.
Mm.
Just can't.
Yeah.
Number 1. Number 2 is most of our clients, they just want passive income. They don't want to deal with the property anymore. They use the word annuity to me. I'd like something that looks and feels like an annuity, which is something that's money just comes in. And it's pretty easy to do. And it's just following the laws of the 1031 exchange.
Okay. So you can 1031 exchange into the DST
Yes.
to defer all the capital gains
Yes.
taxes. Okay. Yeah. That's awesome. Anything else you want to add to that?
Yeah, no, I think the biggest aha that I've learned from working with a lot of families, thousands of families, is they're concerned about owning the property.
Yep.
They don't want it anymore. Right? They don't need the money. They don't want it anymore. They're concerned about capital gains taxes.
Yep.
So they're stuck. They go to their CPA and they say, don't sell it because of capital gains taxes. And nobody's really talking about the 1031 exchange. We've been doing this for, 19 years now, teaching it, because we believe it's the most underutilized tool in real estate in America today. And that's why we're on this national mission to train tens of thousands, hundreds of thousands of realtors to get them to think differently about looking after our clients' money, not only ours, and using tools that are available. I think part of the reason why the real estate industry doesn't talk about 1031 exchanges is because most brokerage firms say don't talk about tax. You're not a tax consultant, right? I'm not a tax consultant by any means. I kind of know the general rules though. And then I guide them to speaking to their tax consultant, because I can't represent the tax consultant, right? That's a good reason. The other could be that they tell us, the world tells professional industry, never use the word guarantee, right? Don't guarantee it. You can't guarantee anything, Dan. I said, well, yeah, sort of. I said, well, I can tell you there's 2 guarantees I got for you. And people say, well, you can't guarantee anything. And I said, well, there's 2 guarantees I can tell you. Can we agree that at some point in our life, we're all going to leave this planet? At some point in our life, we're going to die. Can we agree that that's a guarantee? And they go, yeah. Well, it's kind of weird. People think I'm weird. I talk about death every day. I'm okay with where I'm going, and I'm hoping you are too. But my point in the matter is if it's going to happen, why are we not prepared for that day? Did you know that 70% of families have some level of dispute with their kids after their parents pass away? That's horrible. And that's what we're on. We're on this national mission to keep families together. And about half of those families, the fight's over real estate. That's a problem. Well, we're solving that problem with helping people create real estate plans, helping them understand that there could be a way to prevent family disputes.
Yeah.
Because I asked them all, at the end of the day, when you're gone, who's going to get what?
That's a great question.
And they go, I guess my kids. I said, well, how do you know? I said, well, it says it in my trust. And I go, well, what's it say in your trust? It says, oh, I don't know. So they go read their trust. It says, oh, yeah, it's very clear. It says my kids will share it.
Yep.
How's that going to work out? How do you share real estate?
Yeah.
Unfortunately, that's where a lot of disputes are. And what we're on a national mission to share with real estate agents as well as consumers, because there's a new book coming out regarding that, is the question is, do you have a real estate plan for that day that you know is going to happen? Is your plan set up such that your kids will love each other forever?
Wow.
So that there'll never be a family dispute? Is your plan that clear? And frankly, nobody really has a plan that's that clear. Yeah. The other guarantee that I give people is that, can we agree that upon the demise of the spouse's married couple, one passes away, the other one's a widow, and upon the passing of the last surviving spouse, that's typically the date of transfer of wealth. And so my next question is are you prepared for that day? Yeah. What's it going to look like? Do the people that are your trustees, and typically the kids are the trustees, right? You trust, the one you trust the most will be the trustee. And are they prepared for that day? Are they prepared to make decisions on who gets what? Yeah. Because their trust typically isn't real clear on that. There are exceptions where we've helped clients, and we have good attorneys that will structure it such that each property is earmarked for each child. That's the safest way, right? Yeah. But even when you do that, people do that in advance. They say, okay, don't worry, Dan, I got 3 properties, I got 3 kids, I don't have a problem. Yeah. Well, my next question is, well, okay, it sounds like you've got a good plan. I said, so just curious, who gets the first pick? Yeah. Or who do you love the most? Yeah, exactly. And then when you're gone, what do the others that didn't get the best property feel about that? Yep. And most families don't have a conversation around it. Yeah. Now, again, I'm not saying all families are like that, but a vast majority have these issues. If you're talking about things, if there's clarity, if there's understanding, that's our goal. Yep. So that at the end of the day, when you're gone at the funeral, you're not fighting, you're rejoicing on the blessings of your parents, of the plans that they had for you to build a life worth living, the life that is created a legacy for them and the future generations. Yeah. Right. Yeah. And so that's kind of what we've been doing for the last 20 years, is building real estate plans. Plans that prevent the family dispute, plans to eliminate capital gains taxes, and plans to create a legacy while you're alive. Wow. Before you find out when you're gone, then the family's fighting. Yeah. So that's kind of what we've been doing.
That's awesome. Yeah. Yes, thank you for sharing. So yeah, if you guys want any information on, how to build a real estate plan, or want to just learn more information about capital gains taxes, you can go to our website, iharateam.com. You can check us out there. You can reach out to us there as well. And we want to hear from you guys. So any questions that you guys have, drop a comment. We'll make sure to answer those. Yeah, we want to get back to you. We want to hear the feedback and make sure we answer the questions that you guys really want to know. So that's it for today's episode of our podcast today. Thank you for listening. We really appreciate spending time with you folks. And yeah, have a great rest of your day.
Thank you. Aloha.